You're watching Trading Day on BNN Bloomberg. I'm Amber Canmore. One of our top stories is that dismal job picture in Canada, unexpectedly losing nearly 3,000 jobs. Economists were looking for a net gain of nearly 25,000 jobs. What happened? Well, under the hood, you might want to take comfort in the fact that there were significantly more full-time jobs created, and most of the job losses were in the part-time category, except most of those jobs were in the public sector. Private sector actually shed jobs. Let's bring in Andy Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. You know, sometimes you can look through the details, Andy, and say, oh, it's not so bad as the headline suggests. I don't know if this is one of those times. How are you thinking about it?
Well, a bit of a mixed picture, I think, Amber. I think the fact that we saw such a solid gain in full-time jobs, is somewhat reassuring because we tend to think of wage generation in the full-time sector as being perhaps a little bit better than what we see in part-time. So I think there's a little bit of an added boost to consumer spending coming through August into September. However, the unemployment rate continues to edge higher, and economists, we tend to look at that as one of the leading indicators for consumer confidence. So we could see a drag on confidence going to September, which again could negatively affect spending. So I would call this report a mixed bag, and I think it underscores what Tiff Macklem said at the last Bank of Canada meeting, that this economy is still operating with excess capacity, and we're seeing in the jobs market.
I guess, does it mean that there is a green light for rate cuts? And I ask that because wage growth still above 5%, 5.2%. Economists were expecting a big slowdown down to 4.8%.
Exactly, Amber. And I think that goes to the mix that we saw in the report. I mean, those full-time jobs, that is going to have an upward impact in terms of wage growth versus what economists had thought. Economists were not looking for a 65,000 increase in full-time jobs. Having said that, I think we've got the ingredients in place for probably another 2 rate cuts in Canada on top of the 2 that we've already got. And that is some saving grace, because if we weren't looking at that right now, we would be talking about an increased probability of recession. I think the rate cuts that we have in the tank right now, and the ones that I think we will see in the months to come, will insulate Canada a little bit more from having to endure a consumer-driven recession.
Just 2? The market is pricing in more than that. Do you think that's unlikely?
Well, I mean, 2, don't forget, we don't have many more meetings left before December. So unless we're starting to talk about intermeeting moves, which I don't think most economists are, whether it's 2 or 3, I think right now the bank is going to be diligent. They're not going to take their eye off the inflation ball. To your point, Amber, if we have continued pressure, upward pressure on wages that could feed through into services-based inflation, the bank is not going to want to see that and is not going to want to be that quick in delivering more rate cuts than necessary. I think 2 for now is prudent. Keep in mind, we're also going through an election cycle, and we still have not seen the Federal Reserve cut rates, although people are talking about perhaps an intermeeting move there.
Right, which I think maybe now that we've actually lived this week, is it looking increasingly unlikely? The question is, what comes after September? Will it be, or even at September, will it be a 50 basis point cut as the market is pricing in? Do you think they'll be that aggressive? How aggressive do you expect easing by the Fed to be, and is it informed by some of the events over the last week?
Well, we're still sticking with a 1/4 point cut for September. I think in hindsight, and a lot of economists were suggesting that perhaps they should have started with a 1/4 point cut at the last meeting instead of pausing and providing guidance in the September. I mean, I wouldn't take 1/2 point off the table, Amber. And I think if the numbers between now and then were really to show an economy that was not only slowing, but really starting to come apart at the seams, if the inflation numbers were in fact pointing to, getting to 2% well ahead of schedule, then 50 basis points might be on the table. But I think right now the Fed would not want to go that way. And again, we're going into an election where even though you have an independent central bank that will set policy according to how it sees things developing, is not going to want to make major moves unless absolutely necessary. And I think right now we're going to stick with the view that things are slowing, things are cooling off. There's a rate cut in the offing. 1/4 point, I think, is still the base case.
So what does that do for the rally that we've seen in equities up until this point? Understanding that July was not great, August is a little bit messy, but you're still sitting on some pretty nice gains. Do you expect chop going forward?
Well, I think this was a bit of a normalization, Amber. I think the jolt that we saw on Monday, keep in mind that if you look back to up until the middle of July, we had volatility in this market extremely low. And I would argue that volatility was not matched by the risks that were actually on the horizon. So I think this is a healthy normalization in volatility. If we get the VIX trading 20 to 25, I think that's fine. I think markets can continue to do better provided the data supports the rate cut call for September. So we're definitely not panicking at this point. I think there's some opportunities that were offered to investors earlier this week. And I think we're just going to see a different reality where risks in the market or risks on the horizon, are in line with the valuations of the market, which they were not in the beginning of July.
All right, Andy, thanks so much for joining us with these insights. That's Andrew Pyle joining us, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. One of the trending trades we're watching this hour, shares of Canopy Growth. The stock is plunging on the back of its latest quarter. We've got the CEO on deck next to take us through what happened.